A bank collapse. It hasn't happened in years, and it really rocked the financial world this weekend. Silicon Valley Bank collapsed Friday, leaving customers kind of scrambling and lining up this morning, hoping to get their hands on their cash. The Fed stepped in and issued emergency measures, hoping to keep financial markets stable. So how did we even get here? Let's dig into it.
And it was a slow-moving crisis because if you look back, say, 18 months ago, we saw the tech sector booming. And one of the banks that did tons of business with the tech sector was, in fact, Silicon Valley Bank. So as those companies started to do really well, what did? They deposit more money at the bank.
So just a year ago, tech companies and their bank accounts, they were doing just fine. Even with all those cash deposits, banks usually only keep enough cash for a day-to-day withdrawals. They invest the rest in bonds. In this case, Silicon Valley Bank invested in longer maturing bonds with higher interest rates. It was a riskier decision, but it had a higher payoff, and it was working. Until, of course, the Fed started raising rates last year to fend off inflation. And that's when the bonds lost their value.
What happened last year? The Fed started raising rates. The value of the bonds went down. As these tech companies needed more and more cash, all of a sudden Silicon Valley Bank had to sell their bonds at a loss. And that put them in a terrible situation. I would say that this is essentially went from a cash crunch to a full-blown run on this bank.
It was really a downward spiral as uneasy investors took out more cash. The bank failed. So what do we know about the Silicon Valley Bank? Well, it is or was the 16th largest bank in the U.S. with about $210 billion in assets. Customers who banked with them were largely in the tech industry, lots of startups and venture capital firms opening accounts. Startup companies rely heavily on cash, putting a big strain on CEOs trying to do things like pay employees.
If you're a startup, cash is king. The cash and the workflow to be able to have runway is critical. And so access to the cash to be able to now pay your employees to actually cover the expenses you've got is the thing that I'm mostly worried about. It's just to make sure that we can do that. And so we'll figure out a way to bridge and manage that.
The federal government announced emergency measures on Sunday to help stabilize the banking world and, most importantly, protect those who were banking with Silicon Valley. All customers were ensured that they would have full access to their money as of today and that the FDIC would cover all of their losses. An important note here, the money from the Fed is not being used by taxpayer money. Instead, that money will come from fees that the banks pay into the Deposit Insurance Fund. Customers are the only ones getting this protection, not the investors who took the risks on the bonds.
Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Experts stress that most other banks are not at risk, but a second bank did in fact close in the wake of the Silicon Valley Bank issue. Signature Bank was forced to close and was taken over by the New York Department of Financial Services. That smaller regional bank caters to many New York small businesses. The quick takeover should protect customers and their deposits. Now, even with the uncertainty, some customers say they believe the benefits of a smaller bank usually outweigh the risks.
We've always liked smaller banks where I can walk in with a branch manager, knows my name, knows my secretary's name, where I can pick up the phone and get service. There's nothing wrong with the Citibanks or the Chases of the world. I'm not going to get that kind of service at those kind of places. So that's why we've always in our practice always had smaller banks.
Now let's go back 15 years. The last time we saw a bank collapse was in 2008. The financial and housing market crisis led to major shakeups all along Wall Street. Washington Mutual Bank melted down, marking the largest bank collapse in U.S. history. Experts say it was a result of a much different issue.
This is an idiosyncratic situation. A bank that does business with startups, tech, crypto is different than all the banks being involved in the mortgage business. The other thing that's important, when we did the bailout back in 2008, we bailed out the companies, their shareholders, and management. The government is not doing that. They're protecting the depositors. But remember, shareholders and management, they're out.
The 2008 crisis led to new regulations aimed at strengthening the U.S. financial system. Banks were required to have more money on hand for emergencies. Of course, no one likes to fail, but it is a big part of life, right? One we often cannot avoid. You've heard the sayings before. Oftentimes, you can learn the most from your failures. Well, experts say that's even the case when it comes to these banks failing.
Sometimes bank failures are good. What we're looking at is sort of a correction. It helps reveal what possible bubbles are out there. Sometimes when these things happen, it exposes where we're weak. And that's, again, why the government took such a big step over the weekend to try to save the bank and create confidence. And so, again, sometimes we learn from things falling apart, breaking.
A big lesson to learn from the bank collapse is how to make sure that your money is protected. Braddock says multiple accounts is just one way to do that.
The FDIC is going to ensure and protect up to one account per title. So if you can have one account in just your name, that's going to be protected, and then maybe one account that's jointly owned. So there's a variety there. Multiple banks and investing and things of that nature is ultimately going to create different buckets of money doing different things for you at different times.
Another way to create an extra sense of security is to look at using multiple banks. As you heard him say, you can find the best account for you by shopping around. And to see what fees and terms are out there for the different banks, Consumer Reports recommends looking at websites like bankrate.com and NerdWallet.
Each type of bank has its own positives and negatives, so it's important to figure out what's most important to you when you're looking for a bank. You might even find that it makes sense to bank at more than one place at a time.
Once you do your research, if you choose to change banks, make sure you have a plan to do that. Be sure to open up the new account before closing your existing one. And if you use direct deposit, be sure to change it to the new account, as well as any automatic bill payments. And lastly, transfer any remaining money and close that old account. Bottom line, when it comes to your money, this is not a panic situation. The federal government stepped in and prevented any domino effect from the Silicon Valley collapse. Your money is safe and protected in your accounts.